Good morning. It is Monday, February the 2nd. Here's what's on the agenda. A metals rout for the ages. Oil takes a tumble. And Nvidia has commitment issues with OpenAI.
Tom, good morning. There are multiple assets that out there that are seeing 2, 3, possibly even 4 standard deviation moves this morning. I've picked a handful. There are many more. Gold is at 4,500. We're down by circa 8%. Brent crude is down 5%. We're at 65.79. It's rippling into the equity markets. Europe is down by 1%. The Nasdaq is down by 1.5%. Maybe even more today, but we're going to watch the relationship between all these different assets. What's the portfolio effect? Does one asset affect the other? Does it affect the other? That's what we're going to watch this morning. The countdown to the opening trade starts right now. Good morning. It's going to be a big morning. I hope you've had your coffee. You might not even need coffee this morning. There's so much going on out there to wake you up. We are going to start talking about what is happening with the metals, but we're going to talk about tech. We're going to talk about all these assets. The relationship between them is interesting. Does it come back to what is happening at the Fed? I don't know, but there's lots to discuss. We can't put our finger on what is happening here exactly. What we do know is that the price action in metals is extraordinary.
When does this price action, when does it find a floor when it comes to precious metals? What are the secondary and tertiary effects of this in terms of the deleveraging that comes about as a result of the continued sell-off that we're seeing in silver and gold? And it is now, particularly when it comes to silver, at historic levels. We wiped out year-to-date gains for silver. Gold continues to be under pressure, and of course the industrial metals as well. Copper breaking through some key levels. That is the price action today. What are the broader effects of this? Is there a black swan event on the horizon as investors deleverage given their massive exposure to these precious metals?
As I say, 2, 3 Sigma events happening in multiple asset classes this morning. There has to be an effect on people's portfolios. People have taken on a lot of leverage. How is that going to work its way out over the next few sessions? How much visibility do we have at this point? How much are we going to get? This is kind of, you can't have these kinds of moves without kind of derivative effects into other areas of the market. So the gold and silver and copper and Bitcoin stories are extraordinary. But what does it mean for... We're seeing the dollar moving a lot. Is that the genesis of all of this? What does it mean in terms of the treasury market? What does it mean in terms of people's portfolios? That I don't know. But they're extraordinary moves and they will have an effect.
So the dollar is up again. The Bloomberg Dollar Index is up 0.1% today. Treasuries are playing that role now of safe haven. We haven't seen that for a while. Yields are down across the curve. How much of this is a Kevin Warsh story? How much of this is a story about President Trump and the team conceding that they can't completely reshape the Federal Reserve in their image? How much of this is about Chinese speculators when it comes to the silver and gold and copper markets? Do Chinese speculators, do Chinese investors come back in before Chinese New Year gets underway? That is a question that remains unresolved as well.
We don't know this morning. All we can do is sit and watch and see the price action and see how it percolates into different parts of the market. But your point about China, I think, is really interesting this morning. The point about the balance sheet and the Fed and what it does next in terms of the sort of balance sheet, huge for financial assets. Let's talk about oil and what's happening there. Big move lower on the idea that maybe actually we are seeing a de-escalation around the Middle East, Iran story. But I don't know. President Trump in the past has been very keen to use the element of surprise. Are we just seeing a pause? Are we seeing a misdirection? I don't know. Or is it a reaction to the dollar? There's part of that in the mix as well.
There has been no supply-demand impact or supply impact. And that, according to the reading, at least from some analysts, is key. At least when it comes to how you think about the oil pricing. And the context, of course, is that oil had its best month last month in January since about 2022. But now under pressure, as you can see, Brent trading at $65, just shy of $66. At $62 is the pricing on WTI, down 5%. And as President Trump's team will tell you, it is only the president who knows ultimately the answer, whether or not these conversations actually make progress. He says they're in talks with Iran. And of course, you had the OPEC Plus decision as well to maintain a hold. And the view from previous insiders of OPEC Plus is that until they see disruption from supply, they're not going to change their thinking at OPEC.
This was meant to be the year of the glut. It's not turning out to be the year. Prices were meant to go down, not up, but they've gone up. Now they're coming down, but they've gone up, which is a surprise. So these markets continue to confound expectations, mainly because of what President Trump is doing. So keep an eye on what happens there. The AI story. Jensen Huang's comments were just amazing. And the Oracle story Sunday night, absolutely fascinating.
Jensen Huang has been such a clear and vocal cheerleader. He has not wavered until now, and until a question about $100 billion of investment into OpenAI, and you start to see the leader, the CEO of Nvidia, starting to waver, starting to question that commitment. And that was enough from the champion, the bullhorn, of course, on AI enthusiasm. That was the trigger, on top of the question marks about Microsoft, for this sell-off that we're seeing. And as you noted this morning in our morning meeting, South Korea has been badly hit as well. SK Hynix, Samsung, all feeling the pressure as well.
But it's totally logical, isn't it? You think about it. We thought these were commitments. We thought these were solid commitments from Nvidia into OpenAI. What else do we have to question in terms of all these deals that have been done? Are they all solid? Are they all just sort of...
What's the handshake and what's the contract?
Precisely. And again, we don't know. There's a funding round happening at OpenAI at the moment. But OpenAI's made massive commitments to Oracle.
Yes.
And others. And you now see Oracle, like Sunday, I can't remember the last time I saw a massive tech company come out on a Sunday night and make the kind of announcement that it's just made in terms of its funding, which should be dilutive. It's going to go back to the credit markets, but it's going to issue equity as well. Big jitters. You look at what is happening with the CDS at Oracle, it's moved massively. This is the kind of the epicenter of the action. But if Nvidia doesn't fund OpenAI, can OpenAI fund Oracle? And if Oracle doesn't get funded, what on earth is going to happen further down the road?
Because this is funding up to $50 billion. And to your point, part of that is to build the infrastructure to meet the commitment, the contractual commitment with OpenAI. And the stock, of course, for Oracle, down about 50% since it met and hit that peak in 2025. So how well will the markets receive, to your point, that equity and debt offering from Oracle later this week?
Where do I hide? Where's my safe asset in all of this? What's the story in portfolios around Europe this morning? Should probably try and answer that question. Let's
bring in a CEO right now with a particular lens on the wealth business and the wealth industry. We're going to bring in Stefan, Bollinger, CEO of Julius Baer. Stefan, we want to get your views on what's happening in the markets, but we'll start with the results. And the top line in terms of AUM meeting the estimates at Julius Baer, assets under management, operating income falling slightly, falling 3%, but above the estimates. Talk to us through about where these results leave the business as you look to the rest of 2026. And what is your outlook for flows for the business?
Good morning, and thank you so much for having me on the program. 2025 was a very strong performance for us. Headline profits were down 25%, but as we discussed previously, they were affected by a number of one-off effects, the divestment of Brazil, normalization of tax rate, and also credit provisions. Really, to get a sense of our underlying business, you should look at the underlying results, which have been very strong. Operating income up 6%, costs just up 1%, and therefore pre-tax profits up 17%. We also made a huge amount of progress on the cost side. Cost-to-income ratio is down a full 3 percentage points to 67.6%. And we're extremely strong capitalized with a core tier 1 ratio of 17.4%. As you said, we had record all-time high in asset under management of 521 billion, driven by solid net new money. So overall, a very strong result. And I think it's a great opportunity to say congratulations to our whole team and thank you for the massive effort they did to make this happen.
Stefan, what do you expect to hear from clients on a day like today? What are the potential derivative effects of the kind of route that we're seeing, not just in precious metals and industrial metals, but in the equity space as well, and big question marks around AI? How does that change client behavior, do you think?
Look, our clients have a very long-term view. Our job is to help clients navigate these turbulent times, which are quite challenging for many. I'm very proud with what the team has done, particularly in the last few weeks. You mentioned the metal market that has been exceptionally volatile. We have great expertise in that field, and we've been able to stay close to our clients and help them navigate these turbulent markets. Overall, I think
Stefan?
clients are still... Hey, Guy.
Sorry, continue the thought.
Sorry, Guy, can you repeat the question?
Okay. What have clients been saying? Clearly, we are seeing massive 2, 3 sigma moves, standard deviation moves. How comfortable are they with their current positioning? You talk about giving them advice. What advice are you giving them?
We advise them to stay diversified. They have naturally had a lot of dollar exposure given US assets performed very well. So some of them we see trimming that a little bit. But this is a great time to actually add to positions and make money long term, because our clients are not exposed as much to this short term volatility as maybe some of the speculative flow like we've seen in silver.
But we have seen obviously some fairly big turbulence. Are you confident that your clients will continue to invest for the long term? Like, these are the kinds of events that shock portfolios.
Look, we've seen this type of volatility before, obviously during COVID, we've seen it in the financial crisis, and one way to really make long-term money is to focus on strategic asset allocation, to rebalance when markets tank, and that's how you make long-term money. And this is our job, to make sure that our clients understand that they don't panic and they keep investing.
Do you worry about the secondary and tertiary effects of this? Do you think there will be funds that will be exposed, that there may be some pressure that comes through more broadly beyond direct exposure to precious metals?
We have not seen that so far, and if I look at our own portfolio, we have had very few margin calls, and they were focused around precious metals, and our clients have been very disciplined, and so far no panic here.
Okay, Stefan, one of the things that we've seen obviously at Julius Baer over the last few years has been some credit stress. And I'm just wondering whether or not you are confident that the portfolio, that the setup at the moment is robust enough that if we do get some turbulence in markets, that there won't be any more credit events. I think that's what a lot of people are going to be looking for. Have you cleaned up everything sufficiently that that is not going to be the case?
Yes, absolutely. We feel extremely confident about our position, our credit portfolio, after doing a very thorough review at the end of last year. As you know, we have a new strategy that focuses entirely on wealth management. We have a new risk appetite statement. We have a new risk infrastructure. We have a new chief risk officer, a new chief compliance officer. So I feel very good about where we are, and we can withstand some of these turbulences. We have had
excellent. Good to hear,
90
Stefan.
consecutive years of being profitable. So we're very confident in our ability to weather storms.
Stefan, good to hear. Thank you very much indeed for your time this morning. Stefan Bollinger, the CEO of Julius Baer. Thank you very much indeed. We're going to carry on the conversation, focusing on what is happening with these markets. Ole Hansen, Saxo Bank's commodity specialist, is going to be joining us shortly. Jane Foley, Rabobank FX strategy head, joining us on this dollar move. Henry Allen, Deutsche Bank macro strategist. What is this all about? What is going on here? Can we point the finger at Warsh? Is there other things that are happening here that we need to pay attention to? Carol Knackley, Crystal Energy CEO, joining us as well on this big move we're seeing in energy prices this morning, Tom.
And that ties in, of course, to what's happening on geopolitical front. President Trump saying he is in talk, at least the team in the US are in talks with their Iranian counterparts. Coming up then, Iran's supreme leader warns of regional war if the US launches military strikes. We will have the latest on that front. Plus, could ASML take a hit as the tech sector is put on notice by Jensen Huang's OpenAI comments? We're going to watch that stock at the open. And up next, as metals melt down, basic resources are seen opening lower at the open as well. The miners will be under pressure. We'll get more analysis in terms of what is happening across these commodity markets. If you have any questions of your own for our guests, send them to us on IB plus BBTV Go. This is Bloomberg. We're about 42 minutes from the opening trade, and brace yourself, it is going to be a rough day for European equities as things stand. European futures pointing lower by 1.2%. We're going to be watching energy, we're going to be watching basic resources, the miners, and of course tech as well. FTSE 100 futures pointing lower by 0.8. DAX futures over in Germany pointing lower by 260 points, and over in France, CAC 40 futures pointing lower by 98 points by 1.2%. Guy.
Gold's $1,000 lower. It's just like $1,000 lower over 2 days. That's Friday, that's Monday, that's where we are. When do you buy? Should you be buying? Is it time to keep selling? Or is it approaching the moment when you want to think about dipping your toe back in the water? That's the question everybody is asking themselves this morning. Ole Hansen, Saxo Bank's commodity strategy head, joining us on the line. Ole, when does that moment come? When would you be really confident saying, now's the time to buy?
Well, I'm for sure not comfortable right now, Guy. That's for sure with the kind of sell-off. As you mentioned, $1,000 down in a very short period of time. I think we obviously have to split this into a couple of things, a couple of phases. That there's no doubt in hindsight, obviously, that this rally was becoming parabolic and unsustainable. We saw the plumbing starting to crack last week. Liquidity dried up, volatility exploded, and there was sure signs that something was going to happen eventually. Warsh, Kevin Warsh was the trigger, but we then also have to ask ourselves: has anything really changed? Not really, apart from the fact that we need to get prices down to levels that probably a more reflection of the underlying fundamentals. So that will probably take some time, but I think gold will probably be the one we should keep an eye on. Central banks will not stop buying gold. They'll probably enjoy the fact they can pick it up cheaper. So gold probably will be the first sign when we get some stability. And also, Guy, obviously we've seen China being a massive driver in recent weeks behind this rally. We need to see where they finally settle in. Silver's limit down has been all day, so we don't really have much clarity right now on the outlook for Chinese prices here.
Is it possible to come up with a fair value for gold, for silver at this point?
Fair value is more a relative story. I would say the silver in terms of where it went relative to gold was well above its long-term average, which didn't make too much sense. And I think also the fact that people just simply forget this. A lot of this so-called deficit, well, the deficit was driven by investment demand, but that comes and goes. What was really important is the industrial demand. And as we approach the $100 in silver, the industrial demand, especially in China, started to show signs of uncertainty or weakness. And with that as well, we just had all the stories in the last 2 weeks of people queuing up around the block just to sell their old silverware. That if you can accumulate that will over time relate into quite a lot of supply coming into the market. So silver is a tricky one. Gold is I would say is more of a sustainable, but in terms of the underlying reason why gold has been rallying since 2022, that has not gone away. I would say if anything, it's probably been strengthening. So fair value is difficult. It's obviously at the end of the day what price investors are prepared to pay.
What are the key levels that you're watching at this point, both for gold and silver, Ole? And good morning.
Good morning, Tom. Well, I was watching obviously the 50-day moving average in silver, which was the level we bounced off on Friday. It was also the 68.2% retracement of the whole rally we had since October. Today we're trading below that retracement level, both in gold and silver, and that does indicate that this is no longer just a very, very deep correction in a steep uptrend. So it does indicate that we need some time for this to work its way through. So in terms of levels, it's very difficult. I'll just probably more look for volatility to start to come down, which makes it easier to trade and also makes it easier for market makers to operate in a functional manner in these markets. And that's really where things started to break last week. We saw the link between spot in London and futures in New York started to become unhinged simply because the volatility was too big. Market makers then cut their risk, their warehousing risk, or the willing to warehouse risk, and the spreads widen out. And we need to see that come down. And that's probably the biggest signal that we start to see price action normalizes, and then we can start to think about what to do next.
And you touch on timeframes. I know clearly it's difficult, Ole, but given your history, given your experience, is this a days-long event? Is it a weeks-long event? Your best guess in terms of how long this continues and when we get to some kind of equilibrium in the markets?
I would imagine it could take it could easily take this week. We need to see, as I said, how China. We need to see China really get their prices in line, because they have this limit down restriction. So we could potentially limit down for another day before that stabilizes, and then we'll have to see where we're left. But it will take days, and also really we need to watch out for any spillover effect to the other markets. You're talking about the equity markets trading lower this morning. We see Bitcoin under some pressure, so there could still be some dash for cash, which will impact all markets, and also some of these that has been very popular recently.
The copper trade this morning is interesting. Is that related to AI and the concerns that actually maybe the data build out doesn't go quite as quickly, or is it related to this story? It's hard to separate.
So it's probably likely a combination of those factors.
Probably,
but what is weighted more on copper right now, as we look at the industrial metal, currently down below 12,600, down more than 4% just in the session alone.
Ole, why is copper down? That's what we're trying to figure out. What's the answer to that question? Is it AI? Is it just a liquidation of everything?
Well, it's a combination of both, Guy. But what we saw last week, and I sent out a warning on my messages, was simply that rally we saw last week in copper to a new record high was completely unsustainable, simply because the short-term fundamentals do not warrant any higher prices at this point in time. We got contango in the London market. We got premiums into China coming down, and we got inventory levels at exchange monitored warehouses at the highest levels in a decade. So the market is saturated with copper here in the short term. So that's probably set up the extent to the sell-off we've seen, which I say is mostly now a spillover effect from metals, and then just this renewed uncertainty in the metal space. But copper is a fantastic long-term story, no doubt about it. But we just have to remember, as Jeff Curry also tends to say on a regular basis, copper commodities are spot products. You cannot buy copper in anticipation of a deficit next year. It depends on where it is right now, and right now there's not a deficit, there is a surplus.
There's a surplus right now. That's the short-term story. But longer term, the play is still there for copper then. Does this look valued reasonably if you have that long-term horizon for copper? Is this a buying opportunity, or do you want to see it kind of 12,000 or below?
As well, there's been quite a lot of speculative interest in the copper market, so we just need to see how they respond in the coming days. But yeah, it's still valid for the long term. But again, as I said, we need to see this market tightens up, and right now it's not tight.
Okay. Ole, if the AI story unwinds a little bit, if all these data centers don't get built, does the copper story still hang up for next year? Does it still work for next year?
The electrification of the world is not only AI and data center. It's obviously a major part of it, but the electrification that we're seeing over the coming years will continue to be very strong and be rolled out. So with that in mind, I think the copper story is still valid, simply because producers are struggling will potentially struggle to meet that demand. We're seeing big mining operations also in Chile, the world's biggest producer, how they're struggling to live up to their own projections for production. So it is a tight supply story as much as a strong demand story we're going to see there.
Ole, appreciate your insights on another big day for this sector. Ole Hansen, Saxo Bank's head of commodity strategy. Coming up, as stocks and commodities sell off, we're going to be talking currencies with Jane Foley of FX strategy at Rabobank. Stay with us. This is Bloomberg.
Monday morning, good morning. There are so many superlatives out there this morning, but the one that stands out to me is gold is down $1,000 in 2 days. We've gone from 5.5 to 4.5. Let's talk about the impact that is having into other asset prices. Let's talk about European futures first of all and show you what is happening. We are down. It's interesting, actually, that the London market is not down by more and in line with other European markets. There's a lot of miners in London, and I would have thought you're going to see quite a lot of volatility in some of those names this morning. Anyway, London is holding up, and we are down across the board. But US futures are down even more, so this session is quite hard to predict at this point. There's the S&P futures story, as you can see. NASDAQ futures in particular, because there's another element to all of this, which is what is happening in tech. NASDAQ futures are down by, let's call it 1.5.
Bonds are arguably the least interesting asset class in the session today. There's a bit of a bid for treasuries, sovereign bonds in Europe, not much of movement. There's a lot more interest in what's happening, of course, as Guy was saying, the equity markets, most prominently, of course, in commodities, but also in FX as well. But the German 10-year currently yielding 2.84, the French 10-year yielding 3.43, and the Italian BTPs at 3.46. And again, there's a bit of a bid across the curve, particularly in the belly when it comes to treasuries, yield down 2 basis points on the 5-year at 3.76. Let's get to what's happening in the FX space, though, because Bloomberg MLIV writes this morning that the dollar's recent rebound off lows will extend, fed by moves in gold and silver as investors pull back from overstretched rallies. For more, let's bring in Jane Foley, Head of FX Strategy at Rabobank. Jane, good morning.
Good morning.
What happens to the dollar then? Further upside for the greenback here? How should we be thinking about...
I think there is a possibility that the dollar will regain some of its footing, because if you think about the appointment, or not the appointment, the nomination that we had at the end of last week for Warsh as the potential next Fed chair, I think that's killed some of the issues with respect to Fed credibility issues and maybe dollar debasement issues. And from that point of view, the market's thinking, maybe there is going to be more credibility in the dollar going forward too. So we have someone potentially leading the Fed, from the spring, who may not be as dovish as the market was expecting. And the S&P is thinking, maybe we're not going to get as many interest rate cuts as we could have done. And the dollar, for the same reason, is thinking, maybe we're going to have a more credible Fed going forward than we would have done. So I think the dollar could have further to go. I mean, it's our view that we're going to be choppy with respect to the dollar. We haven't bought into the progressive dollar decline story. It's more to do with choppy, rangy, big ranges for the dollar as the market sort of potentially quite big, and that's because the market has to digest each of these pieces of news as they come. And at the start of the year, they've been coming thick and fast. So, could we see 120 again? Well, yes. Could we see 116? Well, yes. Could we see it in a relatively fast manner? Well, I think we probably could, dependent on the pace of the news flow. So, choppy, rangy for the dollar, but we don't think there's enough evidence there for the dollar to be structurally weak from these levels. Bear in mind, it's already lost a lot of ground over the last year.
Is this also about where are we in terms of clearing out some of the short positions on the dollar?
Well, I think this is it too, positioning. And I think that's exactly what you've had in precious metals as well, a massive position adjustment, overstretched positioning. So I think that's part of the story. And actually, we could take the positioning argument into sterling too. I think positioning has been really fundamental to what's happening there too. So, positioning, yes, and maybe, last week, the week before, the market was just buying into the short dollar story too much.
Is the dollar leading gold, or is gold leading the dollar?
Well, that's very chicken and the egg, isn't it, really? And I think there's a little bit of both.
If gold continues to sell off, can I assume a stronger dollar?
Well, I think that's quite possible, yes. If you think what could potentially be linking them, it's the conversation about debasement. And the market last year, this year thinking, gold's gone up, people are therefore buying intrinsic assets and, they're worried about US treasuries and therefore let's sell the dollar. But actually, there's no evidence that the market is offloading their treasury positions. Yes, maybe some investors, maybe the big Japanese life insurers are increasing their hedging ratios. Yes, that might be happening, but they're not selling the dollars. At least that's not the tick data that we've had to November is showing us that.
Do we look to June when if Kevin Warsh gets through the nomination process, that would be his first meeting at the Fed? I mean, the markets are still pricing in a little over 2 cuts from this Federal Reserve. That hasn't changed dramatically.
Yes.
Do we assume there's a cut that comes through in June at his first meeting? Do we assume that there's further vocal rhetorical pressure on Kevin Warsh? How should we think about timeframes when it comes to the Fed and the impact on the greenback?
I mean, that appears to be what the market's thinking now, maybe a cut in June. And I think that's probably, right now, given the evidence that we've got, a safe enough bet. I mean, things may change and the market may change its opinion of him between now and June. But for now, that seems like a reasonable thing to say. But, you've got to argue, and this is an argument certainly that my colleagues who are the US strategists think, well, you could have a Fed cutting maybe 3 times this year. Maybe a previous FOMC may have cut interest rates maybe once or twice this year. And to what degree did that extra cut impact Fed credibility? Yes, a little bit maybe, but not in a way that, we're talking about a Turkish central bank scenario. So I think right now, maybe 2 to 3 interest rate cuts seems like a safe bet.
What does he do with the balance sheet?
Oh, you see,
and what are the implications of that for the dollar?
And that, I think, is the most interesting question, really. really, because I think with respect to the short end of the curve, it's quite easy for the market to get its head around that and think, 2, 3, we wait for the data to see. With the balance sheet, it's much more difficult to know. We know his thoughts. We know that the whole quantitative easing thing, he was against that. We know he thinks that it needs to get rid of some of that balance sheet. It's difficult to know what sort of pace he might do that. And what's even more interesting, it's difficult to know what sort of friction that might set him up for Trump or Besant.
But he can't he tick all the boxes? He can cut rates and shrink the balance sheet. But I don't know what the latter bit does to financial assets. The financialisation of the economy has been huge over the last few years, sort of out of 2008 through COVID, massive amounts of liquidity in. The Fed's running ample liquidity operations within the market. It's kept everything going. You start taking that safety net away.
Well, Powell has experience of that. Jay Powell had experience of that, right, with the Powell pivot.
Everything's up in the air at that point because there's been this safety net under risk assets across the risk asset spectrum that has been provided by that balance sheet. If it's no longer there, how much more turbulence are we going to see? How much more volatility are we going to see?
I think we can take some lessons really from the Bank of Japan and their balance sheet. And they are buying less JGBs than they used to buy, and the market is really quite uncomfortable with that. We've seen JGB yields go up, largely because of what the central bank is doing, and yet the market's freaking out because it thinks that there may not be enough buyers to absorb JGB supply. Now, that hasn't been the evidence that we've had, and yet that's the implication for many investors that perhaps don't look at Japan that closely. So, there are lots of implications here to really unsettle the market, and I think that is something that's going to be perhaps the most interesting part of his tenure, assuming that he is put into Powell's.
Where does all of that leave other central banks then, and how we should be thinking about other crosses, FX crosses, in light of some of those question marks?
Well, clearly, what they do is going to be really huge, but we've got to bear in mind here that the Fed right now are in the minority of central banks in the G10 that are still cutting interest rates. So the market's only comfortable with the Fed, the Bank of England and maybe Norway cutting interest rates further. All of the others in the G10, the market's anticipating that the next move could be an interest rate hike. So you immediately have some potential turbulence in the foreign exchange market from that. And we'll get to learn from the RBA this week if they are going to be the first sort of ex-Japan G10 central bank to hike interest rates this cycle. And, we could be seeing that, with the Swedish, with the ECB potentially.
FX volatility is back for 2026.
Well, it might be.
Okay. Because it wasn't there last year,
It certainly wasn't there, despite, a lot of news.
Jade's hedging. What does this mean for the Swiss?
You know what? I actually, in this environment, you can put the fundamentals together and say, well, the Swiss, there's a greater chance that they'll go back into negative interest rates because of this. Actually, I think in the environment that we've got, I think almost irrespective of what they do, I think the Swiss franc is going to be really strong because, if you look at the G10 currencies that outperformed last year, you had at the top of the pile, you had the Swedish and the Swiss, and you've got to ask yourself, is there any coincidence that they both have really good fundamentals, really good budget positions, really low levels of debt? And from that point of view, I think there is this diversification play when the market's thinking, OK, well, maybe you don't have debasement in US Treasuries, but maybe we'll diversify away from that Buy America trade anyway. You see that in emerging markets. I think you're seeing that in Switzerland. I think you're seeing that in Sweden. And I think if diversification, is a thing, which I think it is, I think the Swiss is just going to hold up really well.
Particularly if gold's not working quite so well.
Do you think the pound is overbought?
I think the pound could be overbought. I think the market spent weeks since the November budget getting rid of the shorts because, the Chancellor reads, whatever you might think about the tax hikes, the gilt market liked it. It settled down. And so the market thought, we were short of sterling into the budget in case there was some sort of gilt market event. There was no gilt market event, so the market covered its short sterling positions into the start of this year. And really, after the first few days in January, euro sterling's sort of gone nowhere. But I think right now, we're entering a period for sterling where politics is going to get more juicy into the May local elections, where there could be another leadership challenge for Starmer, potentially from the left wing of the Labour Party. The markets won't like that. So I think there is the possibility of sterling feeling, again, use that word, unsettled through into the spring and into the summer.
We've only just started February. Yes. There's a lot going on. Volatility, the story, big ranges, choppy ranges. Jane, thank you very much indeed. Great to see you. Jane Foley, Head of FX Strategy, joining us from Rabobank. What else do you need to know this Monday morning? Peter Manson, Britain's former ambassador to the United States has resigned from the UK's ruling Labour Party to avoid, quote, causing it further embarrassment. This after the latest revelations about his links to the disgraced financier Jeffrey Epstein. Mandelston is facing questions about payments totalling £75,000 made to him and his partner by Epstein in 2003 and attempts to stop the UK from introducing a tax on bankers' bonuses after a request from Epstein. Staying in the UK, and the Prime Minister, Keir Starmer, says he still wants the UK to join the European Union's flagship €150 billion defence fund. Back in November, the EU rejected the British bid for its defence companies to participate, this after a disagreement over how much the UK should contribute to the fund. And the Ukrainian President Volodymyr Zelensky says the next trilateral meeting between the US, Russia and Ukraine will be held in Abu Dhabi later this week. It comes as Vladimir Putin's forces continue to strike Ukraine. On Sunday, more than a dozen people were killed when a Russian drone struck a bus transporting workers in central Ukraine. Tom.
Here's what else to think about across this week then. Starting today, AstraZeneca starts trading in and on the New York Stock Exchange. US ISM manufacturing PMI crosses, and on Tuesday, this could be an interesting one, the RBA rate decision. Could the Reserve Bank of Australia be amongst the first to consider raising interest rates amongst major central banks in this cycle, of course? Singapore Air Show and the US JOLTS, so job openings on Wednesday in the lead up to non-farm payrolls, if we get those on Friday, and European flash CPI inflation data then and producer prices on Wednesday, as well as ISM services PMI on Wednesday. And on Thursday, central bank decisions from the BOE and the ECB as well. Both central banks expected to keep rates on hold, but the language, of course, will be pretty interesting given all the uncertainty we've seen and changing dynamics around the Fed. And on Friday, it is German industrial production and the big one in terms of US jobs. If we get those, there is a partial, at least, government shutdown right now. Guy, we'll see if we get the non-farm payrolls. There's some interesting forecasts out there in terms of what kind of number we could be looking at.
So the current survey number is 65,000. So that's kind of pretty much steady state given the drop we've seen in immigration. So that changes to a sort of lower level. The whisper number is 51. So the whisper number is below where we are currently in terms of the survey number. But you listen to people like Steve Englander, and he's got a negative number. And the reason for that is we have a new birth-death model that is being applied by the BLS to the data. And there's been this view that we have overestimated non-farm payrolls. The new model is going to take that potentially out and therefore could deliver a shock to the downside. So how would the Fed respond to that?
So potentially this time Friday we could be looking at weaker dollar again on a softer labour market and traders pulling forward rate cut bets from the Federal Reserve.
Does it put the labour... It was interesting that Powell downplayed the labour market's concerns that he had up until the recent meeting. And in the press conference, he was much more balanced in terms of his view on what is happening with the labour market weakness that we have seen. As you say, would a negative print put that back on the table and change the calculus around the Fed? Yeah,
market's still pricing in at a little over 2 interest rate cuts by the end of this year. And, of course, we look to Kevin Warsh and whether he gets through the nomination process in time for May.
Do I listen to Warsh or do I listen to Powell at this point? That's a question. And that's the question that I think is going to be a big issue for markets going forward. Looking ahead to a new Fed chair.
He's a fantastic pick from the president. I think he's got enormous credibility. I think he's got enormous gravitas. I think he's got enormous respect from financial markets, from economists, from everyone. And I think he's going to do just a knockout job.
He's got quite an interesting take on this, obviously. Maybe one more balanced towards the White House. We're going to check market reaction to the Warsh nomination. It's having a huge effect around the world. More on that next. This is Bloomberg. Minutes to go until the cash open here in Europe. Looks like we're going to see a -1. Keep an eye on the miners. Keep an eye on what is happening with the tech story. There's a lot to fold in. The precious metal story absolutely front and centre in everything, it seems, this morning. So let's start there and get Markets Live Executive Editor Mark Cudmore's take on all of this. Mark, price action, metals. Where does it go next? How much further do we have to go? I keep seeing limit down in China, which tells me that there may be more selling still to come. Is that the right interpretation?
That's my bias as well, Guy. But obviously, that's kind of the $1 trillion question. And I mean literally $1 trillion question, because we're kind of at this spillover stage. Obviously, those asset classes themselves aren't going to have that big losses. But what's interesting is that the pain that we were seeing, particularly in silver at the end of last week, but also gold, was very much kind of retail focused. And that's why generally where you're seeing most of the pain everywhere across asset markets at the moment is retail focused. It is the obvious tech names. It's in crypto. It's in silver and gold. It's into those trades which retail got really excited about in the last couple of months, less so in the professional space, which is why there's much less of a volatility spillover into dollar and treasuries, even though the supposed initial catalyst for all this was all about the Fed chair, which should be a Treasury's Fed dollar play, which shows how marginal that was. It was the catalyst that started this, but not really the driver. Retail has taken over. Now, what's happened is the pain has got so bad in things like gold, where there is a large professional exposure, and we're into a new month, which means new month-to-month accounting, that this is going to clearly spill over into being, some fund knock-on effect. And it looks like it might get quite a bit worse. But while Treasuries or while rates markets and FX stay a little bit more contained, there is hope that this may not spiral much more, but certainly we're on tenterhooks right now.
And you touch on it there, Mark. How concerned are you and the team, and what are you watching for when it comes to those potential contagion risks?
Yeah, I think if gold kind of finishes 10% down again today, where it has kind of traded down to those lows, I think that's going to be really, really problematic. And then the other bit is then leading into the tech space. As we know, the big underlying theme of everything over the last year or the last couple of years is the AI theme. And we've talked a lot about how we believe we're in the expansion phase of that CapEx bubble, and therefore that's ultimately a bullish tailwind. But momentum traders have taken it too far in the short term. We've had some poor news flow around that with, Nvidia, kind of the comments around the OpenAI investment. Suddenly, Oracle are talking about raising more money. That's slightly poor timing. We're also in the midst of tech earnings. I think if this spills over more dramatically into the tech space, that's where I'm concerned this really spirals across other asset classes as well.
Mark, the thing that has supported markets, that has allowed people to buy dip after dip after dip, has been this belief that stocks will never go down because the Fed balance sheet will be there to protect them. Is that still the case?
I don't think the balance sheet might not be there as much as possible, but ultimately Kevin Warsh, if he successfully becomes Fed chair, is confirmed, would like to shrink the balance sheet, but he may not be able to given what's happening in market conditions, and he'll obviously choose the right time to do that. I don't think really that's the issue here. Remember, stocks had a really horrendous fall last April, and then they recovered quickly. It's just we've not had a proper washout for a while since last April, and even then that was very brief. So we could get a very, very painful washout given the extent of gains we've seen around the world. Ironically enough, because US has underperformed for the past year, it may not see the focus of the pain. We're going to see some of the retail favourites like Kospi and Taiwan, some of those markets get really hurt if AI falls out of bed.
Yeah, we're certainly seeing that in the session today over in South Korea. Bloomberg Markets Live Executive Editor Mark Cardinal, thank you. And remember, of course, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLIV Go on your terminal. Let's get some of your stocks to watch with Jennifer Creary right now. And it's going to be a busy day. Jennifer, what are you looking at?
That's right. So as we just talked about today, the big story is, of course, what is happening with metals. Of course, perhaps for all the wrong reasons. Prices for gold, silver, copper reversing record highs that we saw over the new year and triggering a sell-off in mining and metal shares in Asia, and that threatens to bleed into European trading today. So, of course, fresh nearly Glencore, Rio Tinto, Antofagasta, all in focus this morning. Next, we're going to flip over to tech, particularly as it relates to the chip sector, and that comes off of bearish comments from Nvidia CEO Jensen Huang in Taipei on Sunday, saying that Nvidia's commitment to invest $100 billion into building up OpenAI's infrastructure, its data centers, was, quote, never a commitment. We have a quote from Jensen Huang saying that we will invest one step at a time, so throwing cold water on that deal that was agreed upon at the end of last year. Finally, we're looking at Julius, Baer this morning, the Swiss bank reporting results as well, reporting a dip in net profit, but stabilizing client inflows for 2025. Now, we had the CEO on just a moment ago this morning saying that, listen, it's a volatile time, but to look at the underlying results. So let's see if investors do that this morning.
Jennifer, thank you very much indeed. Yeah, it's going to be a busy market open this morning. Two kind of big themes that we're going to be watching out for. Clearly, the commodity story, how does that affect the big names, BP, Shell, Total? how are they going to be affected by a big drop in the oil price? What are the miners going to do, particularly the gold miners? How hard are they going to be hit? Evie Hambro's been on many times on this show talking about the fact that even if precious metals prices come down sharply, they will still make money, even at significantly lower levels. But I suspect there's going to be a little bit of volatility in the pricing around these kinds of moves. There just has to be. And then we go to the tech story. Can I draw a line between what is happening with Nvidia to OpenAI to Oracle to the build-out to ASML? How do I work that?
You can draw a line. It's already been drawn, right, with all the funding deals, and that's part of the risk. And Oracle coming to market.
Yeah, but they're dotted lines. I thought they were solid lines. They're now dotted lines.
Yeah, there's question marks over those lines. And in this week, for me, crucially, Alphabet earnings, because this arguably is the company that is best positioned right now on AI. It has the full stack from the chips to the data centers to the end product into the consumer. If Alphabet starts to waver, that, for me, is a really big red flag. At the end of this week, we may have some clarity in terms of just how far those question marks for tech have become.
Anyway, the opening trade is almost upon us. It's going to be a big Monday morning. Stay tuned. We're going to give you all of the price action. We'll work our way through that open in just a second. The opening trade. This is Bloomberg. Welcome back. Let's talk about these markets. Let's figure out exactly what is happening. It is going to be a big market open. Let's talk about the context of where we are. Okay, so this is the S&P over the last couple of days. You get a big move here, gap lower into Friday's session. We then drift sideways through Friday's session, and then we get another sell-off into Monday morning. Is this all related to Kevin Warsh? I don't know. Maybe the market had gone too far. Is it related to what is happening with the metal space? You tend not to get big market events in one asset class not affecting other asset classes, but there's not much of it yet. Is there more still to come? Anyway, S&P futures are currently down 1.5%. The Nasdaq's down even more. European futures are also soft. Watch tech names this morning on the back of that story. Watch the mining names off the back of that story. Euro Stoxx 50 futures are down by 0.8%. The FTSE's down by 0.5%, which is quite interesting. So what's going to support the FTSE? Is the FTSE going to be a place to hide out today? Still got a lot of miners in there. Still got a lot of oil stocks. The DAX is down as well by 0.8%. A fair few tech names in that market as well. It's going to be interesting to see how defence names also trade as well this morning, Tom. There is a lot going on. It is a big market open coming up.
On your stocks to watch, it is the energy companies, it is the miners, the Fresnillos of the world, the Glencores of the world, called lower on TradeGate. It is, as you mentioned, the tech names as well. We'll be watching ASML, of course. So the miners in focus, tech on question marks and a lack of commitment, at least wavering commitment from Jensen Huang around OpenAI and the investment there. Intesa, this is an idiosyncratic story, fourth quarter net beat, but planning to distribute 95% of its profit via distributions in 2026. So watching the Italian banking space from Intesa in focus as well, Guy.
Okay, here we go. Market open Monday morning, new month. Are we going to see a new market? What kind of a market are we going to see? Let's find out. Tech is in focus. Miners in focus. Commodities are in focus. FTSE 100, therefore, in focus. Down by 0.2% at the moment. Let's see how BP, Shell trade in a world where oil is down by 5% this morning. Let's see how the big mining names trade this morning with copper, gold, silver. All of the industrial metals getting absolutely slammed through the Asian session. There we go. The 600 is now down by 0.5%. The FTSE 100 is down by 0.6%. How are other markets going to trade in Europe this morning? We're going to see how the CAC is trading this morning. In some ways, the CAC has, a bit like the FTSE, a lot of what could be under pressure today, but not everything. It's going to be interesting to see how the extra kicker of a bit of tech could hurt maybe markets like the DAX this morning. We'll wait for the DAX to open in just a moment. Tom, what are we seeing in sectors and in single stocks?
Across your sectors, it is industrials right now down 1.2%. Banks also taking a knock, down a full 1%. Tech under pressure as we expected. It's basic resources, the biggest losses coming through there across the sectors. Not unexpected, of course. The miners under pressure. The basic resources sector down 2.5% on the significant sell-off around precious metals and industrial metals. As I mentioned, banks also feeling a bit of a pain point as well. But tech down 1.8%. We'll be looking at the individual names in terms of ASML and SAP, to your point, over in Germany. Glencore, in terms of individual miners on the FTSE 100, Rio Tinto, Glencore down 4%, Rio Tinto down almost 3%. So the miners are certainly feeling the impact. The industrials as well, in terms of the defence names, to your point, Guy, you'd flag this. BAE Systems down 3%.
So it's interesting. You want a place to hide out? You hide out in toothpaste and deodorant and soap and chocolate and all those kind of good things.
Usually where I am.
Yeah, precisely. Unilever is the best performing stock this morning in terms of points. Nestle is up. Some of the luxury names are also catching a bid. British American Tobacco catching a bid. Anheuser-Busch catching a bid. Danone is also tracking higher. So these kinds of safe areas of the market are where you're certainly seeing the bid coming through in terms of the points drop. ASML, HSBC, Shell, Total, Novo Nordisk, Rio. So it's exactly the mix that we anticipate in terms of the downside move. But ASML is down by 3.5% this morning. So it's a tech story as much as anything else this morning in terms of what we're seeing hit in Europe.
And just to reiterate, ASML linked to what we've been hearing from Jensen Huang, wavering, it seems, around that commitment to OpenAI, and also a question mark about Oracle and its plans to raise potentially up to $50 billion US dollars. And interestingly, in terms of that dynamic shift that you've seen and that you were flagging as well, Guy, Carlsberg, names like that, up 2.3%.
Yep. Unilever,
to your point, up close to 2%. Heineken, the beer makers, doing well as well in that safe haven tilt, it seems, in a session today. Let's get more analysis, though.
OK, let's do that. Henry Allen, macro strategist at Deutsche Bank Research. What's going on?
That's a very good question. Well, I think in terms of the precious metal space, what we've had is this huge run-up in January, even with the pullback at the end of the month. Let's not forget, gold prices just had their best monthly performance since September 1999. It's the best month of the 21st century, even with that late pullback. So the fact that we've seen a correction in that is to be expected. And actually, I think it's interesting when we talk about an AI bubble, of course. Actually, if you look at the pattern in gold over recent days, you've had obviously a huge acceleration in 25, the biggest annual gain since 1979. Then into 2026, that accelerates further. You get that pattern which you normally see at the end of a bubble. I'm not saying the gold is a bubble, but normally at the end of the bubble, you then see that speeding up. So we've seen a correction back to more normal levels. But I think the fundamental catalysts behind gold do remain bullish, that at the end of the day, we still have inflation lingering above target. We still have the Fed, who, under a new chair, Kevin Warsh, look as though they're going to keep on cutting rates. And, of course, geopolitical fears are pretty heightened right now. Only last month, we've had Iran, Venezuela, Greenland, concerns around Fed independence. So I think those catalysts remain in place.
So the game hasn't changed?
Not fundamentally.
Right.
And actually, in terms of we talk about Trump put, Fed put, at the end of the day, I think those catalysts behind are continued.
Are you as certain as you once were? So a few days ago, everybody was, the AI trade's still on, gold's still on. Are we not wavering in our commitment to some of these trades this Monday morning? Are we not wavering in our attitude towards the fact that OpenAI may not get funded in the way that it once did, that the gold story out of China may not be as driven as it once was? Just at the margin, because everything in risk models is at the margin. At the margin, am I as certain as I once was?
For me, I am actually. Genuinely. Okay. If you look at the fundamentals that are still in place, I don't think, at least in terms of the last week's new information, they haven't changed. Okay. I think the big information, of course, is for the next 4 years is Kevin Warsh as chair of the Fed. But he was one of the candidates who was expected. We know that he wants to cut rates along at the same time as shrinking the balance sheet. In terms of our expectations, that hasn't changed. Sure, we've had a correction this morning, but only 2 weeks ago we were talking about Greenland. There was a huge risk-off move. S&P was down 2% when it returned. We then come back to all-time highs. So I see it very much in that framework.
This is an overreaction, what we're seeing right now in the markets.
Broadly speaking, yes. I mean, I wouldn't say overreaction, but I think this is a standard correction that you normally get on the bull trend. At the end of the day, you don't hit all-time highs day after day after day. That getting a 1 or even a 2% pullback some days does not mean that you're then going to see a 10% correction. I just see this as a perfectly normal move in that context, particularly given how rapidly some of those moves have gone, particularly in precious metals.
And to your point around AI and the AI trade, your conviction remains, despite the question marks that we're starting to see. Through the end of this week, we're getting more earnings from the likes of Amazon and Alphabet. If you start to see further downside pressure on those stocks from some of the capex spending, do you reassess what happens with AI through 2026?
I think if we saw meaningful changes in capex spending, then yes, that could cause something to reconsider. But at the end of the day, I think the thing is with the bull run that's continuing, yes, the Mag 7 say have been fairly flat over the last 3 months. What we're actually seeing is a broader rotation. But I still think that's part of the AI trade, because I think what will happen, and we saw this in the dot-com bubble when the internet got going, is yes, at first, the positive catalyst will go to tech. over time, they will spread to other firms, other sectors, other industries.
That rotation continues.
That rotation continues because those other industries still benefit from.
But who makes money? Who makes money in that situation? Because this is the question everybody's trying to work out: is can I make money on a data center trade? Maybe further down the road, I can make money on the broadening out trade, and the whole economy is going to benefit from it. But at the moment, it's centered on I'm going to make a lot of money on the data center trade. I'm buying chips, I'm buying data centers, I'm buying sort of copper, I'm buying all the stuff that goes into it. What if that trade doesn't make money?
Well, it's possible that trade might not, but as I say, because you've got that rotation, I actually think that's going to cushion investors. And one thing I've noted as the Mag 7's been flat over the last 3 months or so, the narrative about an AI bubble has eased. That when you're hitting these repeated all-time highs, got another all-time high, another all-time high, oh, is this bubble, is this a bubble? That bubble shatter has gone down significantly, even though the S&P last month still hit 7,000. And I think you're going to get that healthy rotation. Let's not forget, at the end of the day, 23 and 24 was the narrowest led rally for the equity market since the late 90s in the dot-com bubble.
That sounds really smooth, because that's obviously how history works, that we get smooth rotations from kind of big bubbles into... The bubbles deflate slowly. That's not how it generally works, is it?
Well, no, but I think people are overestimating the likelihood of some huge dot-com style crash. I think for a lot of people that was the first moment in their careers. Obviously that was a pretty scarring event. S&P 500 was down 3 years in a row. But correct me if I'm wrong, I think that's the only time since World War II that the S&P has been down 3 years in a row. That is not the sort of everyday correction that you normally see, even if AI does turn out to be a bubble. I don't think it is personally, but even if it does, the idea that we're going to see this huge correction, I don't think is justified even if it does.
I want to bring it back to the commodity story and precious metals. What do you do with basic resources in this environment?
So I think the catalyst for those are still...
The mining stocks, I should say.
Yeah, I still think that, the upward pressure on a lot of commodities is going to remain, particularly copper and stuff, given the need for those in semiconductors and the like. So, when it comes to some of those bigger pictures around mining stocks, I mean, I'm not an equity analyst, I'm conscious, but, given that the fundamental bullish backdrop in the economy remains, I don't see like an immediate correction in those stocks, to be honest.
Okay. And Europe's positioning and how you're thinking about Europe through 2026 and whether or not your view, Europe versus the US, changes fundamentally in terms of what we've seen on the back of the last 48 hours or so. How are you thinking about that regional divergence?
Well, I think the European catalyst is still quite strong, actually, because we've got the German fiscal stimulus this year. I think that's the big game changer that I still think is underestimated by a lot of people. So if you look at some of the business surveys in Germany, they've still been pretty flat, actually. We haven't seen the uptick from the stimulus, but that should really start to hit this year, whereas we offset that against this kind of increasingly sell America narrative that actually, particularly if you adjust in USD terms, so from a portfolio manager's point of view, actually some of the performance of those US assets hasn't been as good as first advertised. Even last year when the S&P was up 18%, if you adjust that in currency terms.
Although if the dollar turns around convincingly, and we've started to see, and if that becomes a sustained story, does that change the fund flows back to the US?
It would do, but I don't see a convincing turnaround in the dollar. I could believe it stabilises, but I don't think we're going to get some huge recovery because you've got that Trump uncertainty, you've got the tariff uncertainty, you've got that Fed independence uncertainty. That's still going to be swirling around for the next 3 years. That's not going to change.
Do you think... So the question over the weekend that a lot of people were asking is, what is Warsh's view on the balance sheet? The balance sheet, the US balance sheet, Fed balance sheet, has been used to support financial assets. 2008, what happened in COVID, providing a huge amount of liquidity and support. What happens if that's not there anymore? We were debating this as you sat down. Would the president tolerate a stock market that drops from this point? Would the pressure on the Fed be insurmountable? Would the pressure on the Fed be so great that it would have to step in and use the balance sheet again? Are we convinced that Warsh's kind of view that you can shrink the balance sheet is feasible at this stage? Is that something, once given, can you take it away?
Well, firstly, I don't think that shrinking the balance sheet is necessarily a bear for equity markets. Indeed, as we were saying before the programme, over 23 and 24, we did have balance sheet shrinkage, yet that coincided with a continuation of this equity bull market. So it's not as though...
There's so much money floating around at that point, still.
That is true, but then Kevin Warsh has said that alongside shrinking the balance sheet, he's also going to keep cutting rates, and that's traditionally also been a bull catalyst. So, I think we're going to get at least one more rate cut, and I'm conscious that he's actually not going to be Fed chair, assuming he's confirmed, until the June meeting. Particularly if we get more labour market weakness by that point, then actually
we're going to get more labour market weakness.
It's possible. We're still doing pretty well in terms of the labour market, and people are warning about that. So he could easily have a fresh excuse to cut rates over and above what there already is. So long as he's still on a rate cutting pattern and not turning hawkish, which I think is going to be a very, very, very high bar at first, considering that he is Trump's appointee, who's already said, I'd like him to cut rates and stuff, then I don't think we're going to see him turning to become a hawk anytime soon. That might be a 27, 28 problem if inflation picks up, but I don't think that's going to be one for 26.
Henry, we really appreciate you turning up on a morning like this and giving us some analysis on what on earth is going on out there. We really appreciate that. Henry Allen, Deutsche Bank Research Macro Strategist, thank you very much indeed. Call 6 looks like this morning. You have a weakness in the chip space, as you can see. ASML is down by 3.3%. You've got some weakness in the defence stocks. Luxury's holding up, but to the right-hand side of the screen, as you can see, that's where the market is migrating this morning. Names like Nestle are doing very well. Let's check in on the miners, see what's happening there. Jennifer Creary is with us.
That's right. Of course, it's no surprise that metals and mining stocks are reacting very strongly to those plunging precious metal prices, silver, gold, copper, really sending those shares down. Endeavour, in particular, 8.6% down. Glencore down 3.4%. All in the red this morning. We're going to flip over to perhaps one of the winners this morning, which is, of course, Pandora, up 8.8% off of the back of those plunging silver prices, coming to the benefit of that Danish jewellery maker. Next up, we're taking a look at AI, of course, tech, coming off the back of those bearish comments from Nvidia CEO Jensen Huang, sending those shares down this morning, more than 3% for most of those stocks as well. Finally, we're ending on oil, of course, BP, Shell, plunging. That's off of the back of easing geopolitical risk. Of course, US President Donald Trump said that the US is in talks with Iran over the weekend, reiterating that he's hopeful that a deal will be agreed, sending those shares down this morning off the back of that.
Jennifer Creary, thank you very much indeed. We'll continue to bring you analysis in terms of the metal space. There's a bit of stabilisation. That's the MLIV blog view right now in terms of what's happening with gold and silver. Both, of course, still selling off, but a little bit of stability. You're back above 4,600 per troy ounce for the yellow metal. We'll bring you more on that evolving story. This is Bloomberg. Welcome back to the opening trade. We are 16, almost 17 minutes into the Monday session. European benchmark is currently down a little over 0.4%, but it's paired some of the heavier losses. And as you can see, the breakdown across the major indexes, we continue to focus on basic resources, the miners, tech and energy as well. US futures also in negative territory. Nasdaq 100 pointing lower by more than 1%. Guy.
OK, let's talk about what's happening in the metals. We saw a big move Friday. We've seen a big move this Monday. A lot of that's been driven out of Asia. Some signs of stabilisation right now, but is that something that lasts? It's a long way. We've got a long way to go, basically. European session, American session still to go. And then we're going to get back into what happens overnight into Asia. Let's talk about all of this and kind of where we are. Martin Ritchie joins us now to give us his take on what is going on from Shanghai. Martin, just give us your take on what you've seen in the market overnight, Europe into this morning. What are you hearing? What are you seeing?
Hi there. I'm sorry to use this cliche, but it has been another manic Monday for metals. We've seen a lot of red across the board. Gold falling by more than 10% at one point. Silver solidly down. Copper and all the base metals tumbling. But this is obviously coming off fairly big highs just 2 days ago. And what we're seeing is, I think, some of that bullishness, some of that momentum trade really just disappearing from the Chinese side. So the talk now is really, when's it going to stop? I'm not going to proffer any predictions on that, really, because it went up so fast that there's probably still a lot of froth in this market. If we look sort of beyond the current sell-off, there are still bulls out there. I noticed Deutsche Bank coming out with a call for gold still to reach 6,000 at some point. That's up, it's still well up from where it is after these recent declines. So still a very sort of mixed picture out there, despite the apparently solid decline so far.
Martin, how sizable is the speculative China trade in silver and gold right now?
It's fairly big. I mean, I could speak definitely more to the base metals markets, but the theme is similar across all of them. That in January we saw just extraordinary levels of volumes, far above previous records for the amount of trading volume on the Shanghai Futures Exchange, which includes silver and gold futures as well. What I'm looking at sort of day to day is how those volumes are changing. We had a record day for copper during that sell-off last Friday. We've seen open interest come down a bit in copper today. That's a sign that some of that air in the market is coming out. Some investors backing out of their positions. But just to give it the scale, that trading volume on Friday was almost twice as high as any record before last Thursday. So really extraordinary kind of volumes coming through.
Just a quick question. The AI trade that we're seeing this morning also having an unwind. Is that what I'm seeing in copper, or am I seeing a broad metal sell-off in copper? Can I separate the two out?
I think it would be very hard to separate the two, just because there's so many other sort of technical and fundamental factors driving copper down at the moment. But what I would say is that some of the more cautious voices on copper over the past 6 months did say, look, as soon as you see that AI equities boom start to peter out, start to fade, copper's going to get hit by that as well. So it doesn't help with this route for metals prices, copper, tin, and the other metals that are exposed to the AI infrastructure.
Martin, thank you very much indeed with the update out of Shanghai. Martin Ritchie, our metals and mining reporter. Nasdaq futures, as we mentioned, lower today as well on those concerns around the AI hype bubble, amongst some at least. It follows comments from Nvidia CEO Jensen Huang, who said his company's investments in OpenAI may not be as big as previously expected.
Sam is closing the round, and we will absolutely be involved in
how much? Can you say how much? Can you say how much?
We will invest a great deal of money. Probably the largest investment we've ever made.
The large?
Yeah.
So is that going to be over 100 billion?
No. Nothing like that.
No, nothing like that. Let's bring in Bloomberg senior strategist Neil Campling. Neil, that comment and Jensen Huang's suggestion that there was not a firm, solid, ironclad commitment around $100 billion of investment in OpenAI seems to be the further catalyst in terms of the downside pressure coming through for some of these big tech names. What do you make of it all?
Yeah, I think let's rewind back. Look at last week. We had questions around Microsoft's capex spend, etc. That was the starting point, I think. And then I think what Jensen said at the weekend was just say that we are committed to investing in the OpenAI infrastructure play. However, we are still going to be fiscally aware of where the investments are. So the $100 billion was such an eye-popping number, quite frankly, last year. I think now it's just a reset in terms of expectations, because let's come back. We've discussed this before.
Yeah.
ROI, it's still important, and we still haven't yet seen proof of the returns on that investment. And so I think investors now are a lot more focused on when are we going to see the ROI? Software complex has been hit massively, but of course when we're supposed to be getting to the proof of what AI spending is supposed to be producing, we're supposed to see it in the software complex. It is not happening.
So how easy is it going to be for Oracle to make money, to raise money?
Well, this is interesting, isn't it?
Yeah. I know it's Sunday nights. That's kind of weird time to come out and announce a big raise.
It's a really strange time. But also look at the kind of raising they're talking about. They're talking about partly equity in terms of coming to market, so there's an immediate...
Does that mean they can't... Are they signalling with that they can't raise it in credit?
Because of what happened with the CDS spreads last year. They blew out massively. Now, also, big tech's supposed to be massively free cash flow generative, That's the idea that we all hear about. Now, let's look at balance sheets. Let's look at, let's say, Apple as an example, generated over $100 billion of free cash flow in the last 12 months. Oracle's free cash flow was negative. Oracle's got a leveraged balance sheet. Oracle also, in this announcement last night, what was different about this announcement for me personally? there was no sovereign wealth funds. There was no private equity that were going, we're going to join in with you. There
was no backstop.
There's no backstop. Now, that sends a worrying...
And they're worried about the credit rating, clearly, aren't they?
Absolutely. Because, again, as I say, look at the balance sheet. It is highly levered, which is quite unusual for a big tech.
Are all these commitments that we've seen being made over the last few weeks and months, are they as solid as we thought they were? If Nvidia's calling into question its OpenAI investment, what else do I need to call into question?
Well, all of these announcements, I mean, it's very circular so far. And then, of course, last week we had all these decisions go, we're going to come to the market quickly, we're going to do an IPO this year, etc. But do you want to do that when you've got lots of questions around corporate governance, about free cash flow, about returns? I mean, there are lots of unanswered questions here. So there is definitely, I think, more and more questions around this whole circular arguments in terms of this investing.
Henry Allen at Deutsche Bank was telling us earlier that there has been a healthy move in terms of the rotation trade, essentially suggesting investors have become savvy to the fact that you can't just pile into all things Mag 7 and hope it's going to pay off, that you've had a rational response to the valuation story and to looking to other winners within the AI space. And he thinks that's been healthy and that will continue to portend upside more broadly for the space. Do you align with that view? How much do you read into that?
I think it's great. It is good, actually, that we are seeing sort of questions being asked, because otherwise it's like if we were just going up, as we were last year, we were going up on the announcements of massive commitments when you didn't see these returns. So it is definitely a healthy thing where questions are being asked. And in the broader S&P market space, let's have a look at the fact that, tech is still the driver of growth of earnings. And that isn't changing in this current quarter. And we're going to hear this week, of course, from Amazon and Alphabet. They're going to be the key catalyst as well coming forward. So let's see what they have to say. But, you still... as an equity market, you're still relying on big cap tech to drive earnings growth.
OK. Big week coming up.
Yep.
Not done yet. It's only Monday. Neil Kempling, thank you very much indeed. You put the Fed balance sheets, you put the AI trade, you put the metal all together. Like so many questions that investors have got to answer. And this whole idea that you can sort of diversify, that diversification gives you protection. But how related is all of this stuff? And if one goes down, do they all go down? What portfolio effect do you see?
And it's those secondary and tertiary effects that we've started to focus in on. We've barely touched on the central banks, of course, through this week as well. The BOE, the ECB, maybe that doesn't matter. Maybe it is about what's happening in AI and the metals trade that overtakes what happens with central banks and the RBA as well. There's a lot more coming up.
Geopolitics needs to be focused on as well. We're going to talk Iran. We'll do that next. Carol Nackley is going to be talking to us about the energy space, which is also being hit hard this morning. We'll do that in just a moment. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. It's bad, but it's not that bad, I think, if you consider what's happening in terms of question marks about AI, in terms of course, the rupture that we've seen in the metals markets with the biggest ever drop for silver on Friday, intraday, and of course pricing plummeting for gold from about 5,500 to about 4,500, currently at about 4,600, and the drop in oil prices. But still, you're seeing drops of around 0.4% across the headline. But again, I think it could have been worse if you build that into the session with all those factors. The DAX over in Germany dropping 96 points. The CAC over in France down 0.3%. And the FTSE 100, with that focus, of course, on basic resources and miners, down 0.4%. Guy.
Europe has a lot of things that are going to benefit from actually some of these trades that we're seeing unwinding. And we'll come to that in just a moment. And that explains maybe the mix we're seeing in terms of the internals. 257 up, 327 down. Volume's actually a little light, which is interesting considering it's the first day of the month and we're seeing all of this kind of movement in other asset classes. But let's still dig into the sort of the story on the upside. Unilever, where do you run to? You run to the safe havens of deodorant and washing powder and things like that are going to continue to need to be required. Unilever is up by 2.26%. Who benefits from a lower silver price? Pandora, there's a stock that benefits from a lower silver price, up by nearly 9%, 8.5%. What else benefits? Richemont. The jewelers are going to benefit from this. In some ways, they obviously sort of change their pricing, but not as quickly as maybe you would suspect. So the jewelers are benefiting from a lower silver, gold, platinum, etc. price this morning. And that's where Europe maybe stands out as an area of stability this morning. There are areas of weakness. Obviously, ASML is down pretty hard on what we're seeing in the tech trade. Shell is down on a lower oil price. Fresnillo, the gold miner, is down pretty hard on the back of what we're seeing in gold and silver this morning. It was interesting, Evie Hambro always talks about the idea that you could see a sharp downdraft in precious metals prices and miners would still make money. But there's obviously a kind of ask questions, kind of later, sell first kind of mentality that comes through. And that's what you're maybe seeing this morning in Fresnillo. That stock down circa 7%, Tom.
OK, how much of all this comes back to the Fed pick? Of course, here's what else you need to know. This morning, US President Donald Trump has selected Kevin Warsh as the next Fed chair, of course, shifting the debate from short-term rates to the Fed's balance sheet and its role in markets. Warsh has repeatedly blasted Fed officials for letting the bank's assets balloon, prompting speculation in markets that he could move quickly to have them drawn down. And the US federal government has partially shut down despite a last-ditch funding deal approved by the Senate. The funding lapse began over the weekend just after senators agreed to fund most agencies until September. The bill includes just 2 weeks of funding for the Department of Homeland Security, which oversees immigration enforcement, instead of shutting it down entirely. The bill still needs to be approved by the House of Representatives. Ukrainian President Volodymyr Zelensky says the next trilateral meetings between the US, Russia and Ukraine will be held in Abu Dhabi later this week. It comes as Vladimir Putin's forces continue to strike Ukraine. On Monday, more than a dozen people were killed. On Sunday, more than a dozen people were killed when a Russian drone struck a bus transporting workers in central Ukraine. Guy.
OK, let's turn back to the geopolitics and talk more about that. Iran's supreme leader, Ayatollah Ali Khamanei, has warned of a, quote, regional war as tensions continue to mount over potential US strikes.
This gentleman regularly says he brought warships. The Iranian nation will deliver a firm blow to anyone who attacks or harasses it. The Americans know that if they start a war, this time it will be a regional war.
Why wouldn't he say that? Of course you're going to say that, but we have the biggest, most powerful ships in the world over there, very close, a couple of days, and hopefully we'll make a deal. If we don't make a deal, then we'll find out whether or not he was right.
OK, let's go to the Gulf, let's go to Dubai, let's bring in Horizons Middle East and Africa anchor Jumana Basetchi to talk more about this. Jumana, oil prices are lower today. That would seem to signal a downplaying of that risk of regional war. Is that the right interpretation?
Yeah, that certainly appears to be the case, Guy, versus where we were on Friday, for example, when I think there was a heightened expectation, even anticipation, that something could happen over the course of the weekend. And you just heard comments there from the Supreme Leader, Khamanei, and warning the U.S. that if they do strike, then this could actually run the risk of broadening out into a regional conflict. President Trump, of course, quipped back that he would say that, but actually he's hopeful that Iran will come to the negotiation table. And so what we've seen is a change of tone, especially in the last 24 hours. The diplomatic channels are being worked, and there's a lot of mediation going through from many of the Gulf countries. Over the course of the weekend, we saw the Qatari Prime Minister, Foreign Minister travel to Tehran. He met with Ali Larijani, who is the Secretary of the National Supreme Council in Iran, very close to to the Supreme Leader. And they talked about the possibility for reopening those diplomatic channels once again with the U.S. Equally, they've talked about Egypt and Turkey playing a mediation role and the need for Iran and U.S. to be talking once again. At this point, it is unclear exactly what terms the U.S. are pushing for. We do know, as per prior episodes of negotiations, they have pushed for zero enrichment. In this case, they would also probably look for a pursuit of or stopping the development of their ballistic missile program, which is one concern, given that President Trump seems to think that they have fully obliterated Iran's nuclear program. But of course, analysts and experts say that that isn't entirely the case. They've just set them back. But ultimately, this could be just a method of buying time, because we know that the U.S. has deployed this armada, quote unquote, to the region. The aircraft carrier, the Abraham Lincoln, is there. They've deployed F-35s, F-15s. They're really beefing up their presence in the region. as perhaps a means of deterrence to the Iranian regime, but it also could be just an opportunity to buy extra time and to bring in more reinforcements, specifically on the air defense side of things. But at least now the market is interpreting it as an avenue for diplomacy once again to be brought up and perhaps re-explored. But we'll see how it all turns out.
Okay, an important update out of the region. Bloomberg Horizons Middle East and Africa anchor Jemana Pasechi in Dubai. Jemana, thank you. Let's stay on the oil market response and bring in CEO of Crystal Energy, Carol Nackley. Carol, good morning. How much of the price action today is down to Iran?
Well, quite a significant share in terms of what caused oil prices to drop down, because we saw how the market last week and the last 2 weeks have been driven by market headline news rather than by changes in market fundamentals, that is demand and supply. So as a result, whenever we had, for example, more an escalatory tone in the whatever coming from the White House or from Iran, we saw an upward pressure on prices. And when they were more like the opposite, like more softer, more linear, more diplomatic tone, we saw prices coming down as we saw today. However, the geopolitical risk premium has not completely dissipated. Everybody's watching very carefully how the situation might unfold in Iran, especially given previous experience over the last year or two when President Trump would say something and then he would use a surprise factor. So this is what the market is still nervous about, and there is a significant geopolitical risk premium. It is less than last week, but it has not dissipated completely. Otherwise, market fundamentals, very little changes here and there. For example, the weather in the US has affected supplies, and that put upward pressure on prices. But we saw Kazakhstan disruptions because of drone attacks on infrastructure in the Black Sea and the Caspian region are being restored gradually. These are small movements here and there and temporary, and there is seasonality, but the main factor is definitely geopolitics for the time being.
What would the oil price do in the event of an attack by the US on Iran?
Well, there are all sorts of scenarios, because if it was, and we saw an attack last year when the Americans attacked Iran's nuclear facilities, we saw a spike, a jump, but it was short-lived, primarily because of the market fundamentals. So we have to take into consideration, one, the scale of that attack and how long it's going to be and what are the repercussions of that attack. So are we going to have a regional war? That would be really the worst case scenario for prices, and we could expect prices to jump and to maybe to stay in the high territory for a while. But if it's going to be just a short attack, very targeted, as we saw with the attack on the nuclear facilities, we might see a short-lived jump, and then the market will correct itself, because there's plenty of oil around. Everybody's expecting a surplus this year. I don't think demand is suddenly booming or growing at much faster rate than supply, and there is still spare capacity in the system. So it ought to answer your question. We have to explore all sorts of questions and scenarios, especially in terms of how will that attack be and what the repercussions are going to be and how long it's going to last, and whether Iran will deliver on its threat that it always reminds us of, closing the Strait of Hormuz, and how long will that be in place. I doubt it's going to be Armageddon, but it's not going to be a pleasant scenario. But the market will correct itself eventually, because there is plenty of oil around.
Carol, the key question seems to me is how much will US drivers pay to fill up their trucks and cars? How critical do you think the midterm elections are in terms of our outlook when it comes to oil? President Trump wants lower gasoline prices. Do you think he's going to get them?
I mean, to a certain extent, he got them since he came to the White House for his second term, when he had his last year's speech when he said that we need low oil prices, and he blamed OPEC for keeping prices high. And we saw how prices after that speech kind of hovered in the low 60s, and they remained range bound between 60 or 70. We rarely saw 70 since he came to the White House. Now, of course, the midterm elections are very important for any president, not just President Trump. And if prices stay in this range between 60 and 70, that is still acceptable, because it seems to be acceptable for the American consumers, but equally acceptable for the American producers, the shale producers. At the same time, we saw the actions in Venezuela and the gradual lifting of or easing easing of certain sanctions in an attempt to kind of fill some gap or reduce nervousness in the market. If there is escalation and or disruptions elsewhere, there is these additional barrels that can come to the market and can rebalance the situation. So definitely they play a role. Prices, the gasoline prices, what you pay when you fill your car, when you go to the petrol station in the US. But I think it is the 60s range seems to have been an acceptable range for the American consumers and therefore for the American president.
In terms of how quickly that could change, is it possible that you could have an attack on Iran, oil prices go up, and they come down relatively quickly and allow actually the US consumer still to feel okay going into the midterms? I'm just wondering what the sort of timelines, how quickly an event in the Middle East could be over. Is this something that would have a lasting effect? I don't know the nature of the attack, but how quickly do you think we could return to lower oil prices and get through such an event?
Well, I tell you, since the share evolution became material, and if you look at historical prices since that period, and I don't like to look only for a year or two, I just look at the trends, I can see that any geopolitical developments, even that affecting a major oil producer, has not really resulted in lasting spikes in prices. So we did not see what we used to see, for example, in the 70s and the 80s. And that's why I'm much more confident today that, yes, we should expect spikes to happen. But in terms of the duration of the crisis, I think the oil market today is much more agile and much more flexible and in terms of responding to these kind of crises than not long ago. I cannot tell you for sure whether it will be 1 day, 1 week, or 1 month, because it all depends on the scale of the attack and what will happen afterwards. What will happen with Iran? Will the Iranian drag other countries into this conflict, regional countries? Then that will be really a serious crisis. But again, even those countries have developed alternatives to get around the Straits of Hormuz. There is plenty of oil around. There is no shortage. What will happen with Russia at the same time? Are there going to be a deal that will allow Russian barrels to float more freely in the market? So there are many moving parts, but it all depends on the scale of the attack. But at the end, we cannot change the fundamental realities of the market, that today oil markets are much more flexible and agile than they were a few years ago.
How much energy, how much oil will Venezuela be putting on the markets by the end of this year, do you think, Carol?
By the end of this year, I would say in terms of the hundreds of thousands of barrels, but not really in the millions. The millions will take several years to materialize, because so far in Venezuela, we only saw the change in president and some reforms are being discussed. But even under the best case scenario, even if reforms are fully implemented and there are new contractual frameworks offered to the big players like the Exxons of this world and other oil majors, very lenient terms. I mean, history tells us that oil will not start flowing suddenly in the market. I mean, if you take Iraq, it took them many years to increase their production significantly and recover to previous peaks. So in the short term, we have to be realistic. Perhaps what can come back to the market from Venezuela is what has been sanctioned, and it was not all of Venezuelan oil that was sanctioned. So if the sanctioned barrels, if those sanctions become legitimate and are allowed to be traded freely, that could perhaps bring more barrels in terms of numbers into the market, but it will be in the thousands and the hundreds of thousands, not more than that.
Okay. Thank you, as always. Appreciate your insights into the energy market, the oil markets. Carol Nackley, CEO of Crystal Energy. Thanks for your time and that context. Coming up, from oil to crypto, another tough day for Bitcoin. When we come back, we're going to answer the question: how much value did the largest cryptocurrency shed in the month of January? This is Bloomberg. Welcome back. Now, before the break, we asked you how much value did Bitcoin shed in the month of January. The answer, 11%. The move lower, marking the fourth straight monthly decline, the longest losing streak since 2018. Its latest slump comes amid broad market unrest, of course, with gold continuing to fall today after suffering its biggest plunge in more than a decade at the end of last week. Bitcoin almost back to levels we last saw since President Trump took office for the second time. Guy.
Let's talk about where we're seeing the equity market this morning. In some ways, you could argue something of a non-event. Yes, you got the miners down. Yes, you got some of the tech stocks on the move. But what you also have on the other side is some of the jewelers in Europe. I think Pandora doing well. Think Richemont doing well. Some of the more defensive names, think Nestle, think Danone doing well off the back of this trade. One seems to balance the other one out. So let's get a sense of where we are with these markets this morning. Cross-asset. Bloomberg's EMEA Equity and Macro Trends Senior Strategist, Michael Masika, joining us around the table, as is Skylar Montgomery-Koenig from our MLIV team. What do you think?
I mean, I think Friday's move was more symptomatic of a market that became very, very stretched than it was a fundamental change. Like, yes, the trigger was the fact that you had the Warsh nomination, and this idea that maybe it means the US dollar is more credible, maybe you don't need to have as much money in gold, but I don't think we know enough about what Warsh will actually do and what his nomination going forward would actually mean for markets, and you got a really mixed reaction as well. And the fact that it was broadly risk-off rather than a discerning reaction to Warsh specifically tells me that it comes from a market that was very, very stretched, hit a level that people thought, I may as well take profits if there's a negative trigger. And it doesn't necessarily have an end in sight because, A, we've only just undone the 2026 gains, so we're still up quite a lot. People can still want a profit take. And if I'm an investor looking at the drop we saw on Friday, I'm not going to want to pile in, despite the fact that all of the reasons people were buying gold around uncertainty in geopolitics, risk of higher inflation, haven't gone away.
And Michael, bringing you in at this point as well. Again, just referencing what we heard from Deutsche Bank and Henry Allen earlier, saying all the fundamentals are still there for positive upside for the equity story in 2026. What do you assess of what we've seen in the last few days and how to think about the year ahead?
So, exactly as Skylar was saying, there were some parabolic moves somewhere in the markets. That's where it was miners, where it was like gold, silver, a lot of metals, Kospi, some semiconductor trades. I mean, all those went just like too high, too fast. There was a lot of speculation. A lot was driven by retail, not so much by fundamental investors like institutions. And the reality is they need to wash out at some point. And we came to a lot of speculations, but the fundamentals have not changed.
Can I say the same thing about the AI trade? Why is that different?
Well, it is a bit different because, again, those companies, the ones that are like AI hyperscalers and everything, they still deliver. They're delivering on earnings. They're delivering on capex. They're delivering. I mean, we see Oracle today. They go into more capex, but this time they're going to finance it through equity raise instead of debt. So this is,
why
the stretch of the balance sheet. Sorry?
Why are they doing that?
Because the stretch on the balance sheet was quite high, and we know that. But that's known. That's all well known. So now it's all about, is this investment going to deliver? But that we'll know further down the line.
Guy Johnson's. I feel like you're much more concerned about AI. Maybe Michael Masika is suggesting quite a cadence.
Well, you see Jensen Huang coming out going, we're not quite so sure we're going to put quite so much money into OpenAI. He has been the cheerleader for so much of this, and as you said earlier on the show, a little bit of caution maybe coming through from Jensen Huang.
Skylar, on the AI theme then, where do we stand on this in terms of, we have big earnings, of course, coming through from Alphabet and Amazon later this week. At the end of this week, we could be in a very different place when it comes to how much conviction we have around AI.
Yeah, absolutely. And I mean, part of the move we've seen in equities on Friday was certainly related to gold, and that like you have such a big downside move, it creates volatility in the market. Certainly there were some margin calls. People are worried about where their money is. But I think the more important trend, as you say, is AI, as in that's what will really impact the equity market because that's what's driven us so far in recent years. It's really been boosted by the fact that you have earnings delivering and that coming through in the tech trade. Now, what we saw last week from tech earnings was you needed a really big beat to get upside. And I think that's what we see this week as well, because there's questions over how sustainable the trend is, whether or not you'll see winners and losers. And I think that's increasingly in the environment, as in you need to be more of a discerning stock picker. And that's actually probably positive for the equity market overall, because it means you're not having this irrational exuberance that tend to lead to a bubble popping. So we'll see how the earnings come in. I do think they need to be quite strong to see a kind of continued rally. But more generally for equities, fundamentals matter the most, and that's the growth story is still strong.
Is it fundamentals or is it the Fed balance sheet? What supported the equity market over the last few years? Has it been great work done by companies, or has it been ample liquidity provided by central banks and the balance sheet of the Fed expanding? I know it's contracted a little bit over the last couple of years. How important has that been?
Bit of both. I would say if you look at the S&P 500 and earnings growth, it's been supporting the rise in the S&P. You have some valuation expansion, yes, but at the same time, if the earnings growth is being delivered the way analysts suppose it's going to be, then in that case, it's still supported by fundamental. Now, for the market on a daily basis and like on a monthly basis, the balance sheet of the Fed is very important. I mean, the liquidity is ample in the market, and it's been supporting the equity market a lot lately. But, again, when positioning is high, when retail action is really strong, you get movement that we see right now, and you get more volatility. We haven't had volatility in a while, like a real volatility.
We have volatility now. The balance sheet hasn't been adjusted lower. But so if Warsh starts taking aim at the balance sheet, do we assume that there is a Trump put?
It's always the same thing. You got elections coming as well.
Sure.
So you want to make sure that people are happy. Yes. I mean, I'm sure in the market there is assumption that there will be either a Fed put or a Trump put somehow, like somewhere down the line.
So you just keep buying dips. Is that the mentality?
I mean, I think it pretty much is. And also you need to think about it's not just the U.S. that's providing liquidity, right? You've got liquidity coming out of China right now, and that's pretty beneficial not just for local markets, but also for more broad markets. And I think there's just really a question of what will actually Warsh deliver on. And yes, we're talking about what he's done previously, but this could be a very different Fed chair than Fed governor that we had in 2008, 2009.
Okay. Skylar, thank you very much indeed. Skylar Montgomery-Koning and Michael Masika, of course, with the analysis on another big day for these markets. Here's what else to think about through the rest of this week then. Later today, AstraZeneca will start trading on the New York Stock Exchange. We'll also get manufacturing PMI out of the US. On Tuesday, it's the RBA rate decision. That's going to be interesting. There has been speculation as to whether or not the RBA will have to hike rates sooner rather than later. Singapore Air Show, which Guy will be watching closely, no doubt, and the US job openings data. So on Wednesday, we're going to get CPI and producer prices out of Europe, and then PMI out of the US. On Thursday, drum roll to the BOE rate decision and the ECB rate decision, but arguably what's happening in AI is more important, the earnings there. Guy has some details on that shortly. And on Friday, we get non-farm payrolls, hopefully, if the government reopens and it's not affected by what we are saying right now, which is a temporary shutdown, at least.
Big earnings week still coming up. You've got Disney, you've got, that's today, European earnings, you've got Publicis, AkzoNobel. Wednesday, Novo, Novartis, GSK, Infineon's out first thing as well. Lilly's out later that day. You've also got the big ones, Alphabet, Qualcomm, Arm are going to be Thursday. You've got Shell, Vestas, Siemens, Healthineers, Amazon coming up that day as well. Big day for the banks on Friday. It is a massive week coming up. We barely scratched the surface. Hope you enjoyed the show. This is Bloomberg.